Hello and welcome to the SWIB Podcast, where members of the Wisconsin retirement system can turn for timely information on the investments that help fund the state's pension system. I'm Chris Preisler, Communications Specialist for the State of Wisconsin Investment Board, or SWIB.
And I'm Dusty Weiss, producer of the podcast.
Over the last 5 years, commercial real estate has seen its share of challenges. From a global pandemic to rising interest rates and changes in trade policies, investors in commercial real estate have had to deal with sometimes extreme market volatility. Despite these challenges, commercial real estate remains an important part of a thriving U.S. economy and the investment strategy SWIB has implemented for the Wisconsin Retirement System Trust Funds. SWIB's real estate portfolio helps diversify the core trust fund and has generated an impressive track record of investment performance, which has greatly benefited the WRS, helping keep it fully funded and well-positioned to deliver on its promise to over 692,000 participants.
So in this episode of the SWIB Podcast, we're going to look at how SWIB's real estate portfolio plays an important part in SWIB's asset allocation. We're going to talk to Jason Rothenberg, SWIB's head of real estate, about some of the challenges SWIB's real estate portfolio has had to overcome, what trends are impacting how institutional investors view the real estate market, and what steps SWIB's real estate team has taken to overcome the market volatility.
The SWIB Podcast is a regular opportunity for you to learn more about the people and funds that comprise the Wisconsin retirement system. Please make sure to subscribe in your favorite podcast app so you don't miss an episode. Share this podcast with your fellow WRS members and leave a review on Apple Podcasts so it's easier for other members to find this show.
Today, we welcome back to the SWIB Podcast Jason Rothenberg, SWIB's head of real estate. Jason joined SWIB in 2011. He earned his bachelor's from the University of Virginia, his master's in environmental management from Duke University, and his MBA in real estate from the University of Wisconsin-Madison. Jason's prior work experience includes serving as director of finance for a real estate development company and in public policy roles with the Office of Management and Budget and the National Oceanic and Atmospheric Administration.
Jason, welcome back to the podcast. Before we get started in our discussion today, can you give us an overview of what SWIB's real estate portfolio looks like in terms of size, types of property, and the team overseeing the portfolio?
Sure, Chris, and glad to be with you guys again. The portfolio is valued around $12 billion, diversified across property types and geographies. We have a team of 7 that manages a portfolio, and we really try to leverage the size and skill set of the team to invest using a variety of structures, ranging from effectively wholly owned assets to commingled funds. I'd like to put in a plug for the team. As we'll get into, it's been a bumpy several years in the commercial real estate market, but everyone's remained laser focused on maximizing the value of our assets for plan participants and also taking advantage of the volatility to find good investments that move the portfolio forward.
You spoke there a second ago, Jason, about how the portfolio is diversified. And like a lot of SWIB's investments, diversified can mean not just in terms of the type of properties that you have, but geography as well. Does that real estate portfolio include just U.S. properties, or are we reaching out into different geographies across the world?
So we do run a global portfolio, but only about 5% of the portfolio is outside of the United States.
And why is that?
Real estate tends to be cyclical, and certain property types in different parts of the world may be in a different place in the U.S. in terms of supply and demand to present better alpha opportunities. I also think that going forward, the current path of deglobalization may lead to more benefits from diversifying across countries than maybe we've seen in the past. That said, there are considerations for a U.S. pension fund like SWIB regarding taxes, legal structure, and currency risk that'll likely keep the bulk of the portfolio closer to home.
So you guys are managing a portfolio of commercial real estate. We don't do investing in single family homes or things like that. What type of exposure do you have to the various types of commercial properties that are invested in the portfolio?
Correct, Chris. We focus on income producing properties, and our 2 largest exposures, each representing about 30% of the portfolio, are in the living or residential sector, which for us is mostly apartments, and in industrial or warehouse buildings. The balance is comprised of some of the more traditional property types like shopping centers and office buildings, but also a fair amount of what are called alternative sectors like data centers, senior housing, medical office properties, and self-storage. We also have some exposure to credit strategies in our portfolio where the underlying collateral is commercial real estate.
And the portfolios that you're managing, is it all active management or is there some passive management to what you're doing?
So we run primarily a private actively managed portfolio, and we work with a roster of 40 to 50 external managers to help provide the support that we need.
Going back to the exposures, have those exposures changed much over the last 5 years or so?
So our portfolio is somewhat representative of broader trends in the industry, which has been increased exposures to the alternative property sectors and industrial assets at the expense of office and retail. If you look at the weightings of some of the benchmark indices that track commercial real estate, office and retail have been effectively cut in half from what they were 10 years ago. And this alternatives categorization that I mentioned is really a misnomer at this point, as these properties are an integral part of most institutional portfolios and continuing to grow larger. So it's been an early mover in many of these sectors, which has been an important driver of relative returns for the portfolio.
Is a real estate portfolio something that's common for most public pensions?
Most institutional investors do have exposure to real estate. The reasons are primarily for diversification benefits, also as a partial hedge of inflation. And, the whole idea going back to it is, the diversification thesis is that you're going to have something that performs differently than equities or fixed income over time.
I think the most obvious thing people have seen probably over the last 5 years and what really is grabbing the headlines is that shift in the office market. That seems to be what we read about most. The pandemic caused a significant change in how companies are doing business. And while some companies have called staff back to the office, many others have continued with remote or hybrid remote policy for their employees. That's led to some companies reducing their office footprints. I saw a report recently, a couple weeks ago, that said this year office conversions and demolitions will exceed new construction for the first time in at least 25 years. Can you take us through what all of that has meant for office properties and how you and your team's thinking about investing in the office sector going forward?
Sure. And it has been quite a challenging period for office owners. It's important to keep in mind that leases for office space are typically longer term. Moving a business or a part of a business is never simple, and a large tenant may sign a 10 or even 15-year lease to provide some stability, both in terms of cost and employee culture. And the world can obviously change a lot over that period of we've seen. During the pandemic, most tenants in institutional quality buildings paid rent, regardless of whether their employees went it or not, which was a good thing if you're a landlord. But what we've been seeing is that as those leases mature, companies are rethinking just how much space they need and what type of environment they want to work in. Lately, there's been an uptick of companies increasing their required days in office, as well as those calling for a full return. But it does seem like the answer for most is some component of in-person work in the office, which most people think promotes better collaboration and opportunities for learning, particularly for junior staff, combined with some optionality for remote work. The result is that we're seeing tenants sign leases for less space, but in spaces that are nicer, newer, and better amenitized. Think more open collaboration spaces, ground floor coffee shops, fitness centers, effectively trying to give plenty of reasons for people to feel good about coming into the office. This has driven a flight to quality in the office market and created an environment of winners and losers. A commonly quoted data point is that 80% of the office vacancy is concentrated in 30% of the buildings. So from an investment standpoint, office buildings are relatively cheap right now, given all the dislocation, which makes them interesting. But it's really a matter of building conviction that whatever building you're focused on will be one of the winners versus the next candidate for demolition or conversion to another use.
Yeah, it's really interesting to hear you talk about that, Jason. And certainly as someone who's been working on and off in downtown Milwaukee for the last 12 years here, something that we've seen play out again and again and again. Chris will tell you this, that in addition to being the co-host of the SWIB podcast, I also run a small business here in downtown Milwaukee and have a small commercial business footprint. But one of the reasons that I chose to put my business where I put it is the fact that it's 2 blocks walk from my favorite deli. But in going to this deli regularly over the last 12 years, I have seen a really precipitous decline in the amount of business that they do during lunch. Being on a first name basis as I am with the owner of the place, he's told me that, yeah, it's the return to the office versus the lack of a return to office that has really caused problems for the sorts of commercial operations that spring up around these large white-collar office complexes. Fewer people in the office means fewer people going to the restaurants, shopping at stores and business districts, convenience stores. There really has been a domino effect. Do you think that we'll ever see a return to pre-pandemic levels for these sorts of commercial leases and real estate, or is this the new norm?
So I think it's taken a while and we're not there yet. And clearly your anecdote would indicate that maybe not in your pocket of Milwaukee, but we're really starting to see a rebound in lots of other central business districts. And again, it always depends on where you are in a given CBD or city. Our team spends a fair bit of time on the road, getting out and walking markets, meeting with investment managers, brokers, and other real estate professionals. And things feel a lot better in cities like Seattle, San Francisco, and Denver today in terms of street level activity and vibrancy versus where we were 3 years ago. It doesn't mean that all these small retailers are out of the woods yet, but I feel like there's more reason for optimism today than certainly I felt a couple years ago. And, New York is a very interesting case study in that it came back relatively quickly and has been doing quite well. Part of this is the city's continued ability to attract young people and tourists, but it's also due to having more exposure to industries with strong in-office cultures that were quick to bring their teams back in. So as you mentioned, having workers come back really does make a big difference to these small retailers.
Within a city, are there pockets, in some of the larger cities, like you mentioned New York or Los Angeles, where there are areas that are doing well in terms of that commercial opportunities, and then other parts of the same city? I mean, are there subsections to markets like that you see?
Yeah, very much so. It's submarket by submarket and it's building by building. And going back to what I spoke about with office, with winners and losers, if you're in a segment with the winners in your office buildings that are all of a sudden feeling vibrant again, you're having workers coming in again, those retailers are doing well. For those buildings that are on sort of the losing side of this, where your building is only 30% occupied, folks aren't coming in, that feels completely different. So yeah, it's almost block by block, Chris.
Well, and that's a really strong vibe that you even just pick up on in walking into a commercial building where it's like, whoa, this place is a ghost town. Don't love this. I mean, that has an effect on the people that are walking in there. But commercial real estate is certainly more than just white collar office buildings and the restaurants and shops that spring up around them. I mean, there are other things out there, the industrial market, retail, multifamily. Did the pandemic have the same impact on those other types of commercial real estate?
Yeah, it's interesting. The reason why we're still talking about the pandemic 5 years later, because of how significant the effects were on the real estate market and how different those effects were across property types. So office is clearly on one end of the spectrum, but for those sectors that saw abnormally large demand increases, we're now dealing with the supply response that demand triggered. So 3 great examples of this are warehouse space, where demand went through the roof as everyone was trying to work around supply chain issues and accommodate consumers flush with cash, ordering stuff because they were limited in spending money on experiences. We had apartments in Sunbelt markets like Phoenix, Atlanta, and Austin, which saw a lot of relocations from other parts of the United States. And self-storage, where there was a big uptick in demand for units from people moving, but also from folks staying put that wanted to free up additional space in their homes. In all these segments, developers race to accommodate this outsized demand, but then as demand is normalized, there's now some excess supply that needs to be absorbed as markets find new equilibriums.
So I'm not asking you to give away trade secrets, but when you're looking at those pockets, the office, is struggling a little bit, but then you're looking at some of these other pockets that were doing well, like the warehouses and things. How do you and your team kind of jockey for position with the other institutional investors? What types of things are you looking for to find those opportunities for SWIB?
Yeah, well, I think critical to us is relying on our longstanding reputation in the marketplace as being a trusted partner and just making sure we have access to lots of stuff to look at, right? So real estate is building by building, and we need to make sure that we're in the flow. And so we obviously rely on our managers, but then also plenty of third-party research providers to try and make sure we're using the right lens to evaluate these assets that we're probably going to hold for between 5 and 10 years.
And then coming out of the pandemic, there's been a new set of challenges that investors have faced, particularly with the steep rise in interest rates. How has that impacted the real estate market?
Yeah, the increase in interest rates has been challenging for real estate. Real estate is an interest rate sensitive asset class. So at the start of 2022, the Fed funds rate was effectively zero. The yield on the 10-year U.S. Treasury was about 1.6%. Today, even with some rate cuts, the Fed funds rate is 4.25%. And the 10-year, while it's moved around a bit, has been around 4.5%. 30-year mortgage rates went from a low below 3% to something closer to 7%. So rates are higher, and they don't appear to be falling back anytime soon. Many investors use some type of financing when they buy real estate, and the price you're willing to pay for an asset is highly dependent on how much it costs you to borrow. And so the ways that investors use to value the income stream generated by real estate, like capitalization rates and discount rates, have needed to be adjusted up to reflect higher base rates, which means that market values have moved down. In other words, the price that people are willing to pay for a particular property today is on average substantially less than it was 3 or 4 years ago, even if that property is performing well solely due to the rise in interest rates.
And you mentioned that real estate's more of a long-term investment, and I'm guessing banks like leases that are longer term. With the interest rates being so high, are businesses looking for shorter leases, and does that have an impact on the market?
So it's an interesting topic. And we actually haven't seen as much sort of a reduction in desired lease term as you would think. And I'm referring here to primarily the industrial and office markets where you tend to sign longer term leases. Obviously, hotels are by the night. Most apartment rentals tend to be on an annual basis. And so what we've seen, I think, is all these companies are trying to balance, how far do I commit in an uncertain future while also taking advantage, quite frankly. If you're an office tenant right now, it's a great time to be shopping for space, and you can lock in attractive costs for a long period of time in a great Class A building. So I think a lot of folks are trying to manage that trade-off.
And more recently, there's been a lot of activity at the federal level, the tariff situation, changes to government-funded programs, and personal and other policy shifts. How have those things impacted building, leasing, and financing properties?
So all the policy activity has created a lot of uncertainty in the market. And effectively, all these proposed changes have some flow through the demand for space, but it's just really hard to know where things will settle out at this point. The most immediate impact in what we've seen has been a slow activity as decision makers are trying to hold out for more clarity. This applies to investors looking to buy or sell real estate, as well as tenants thinking about lease decisions, particularly those that typically sign longer term leases. So things do seem to be better than they were earlier this spring, as we've seen a rebound and some stability in the equity and fixed income markets. But I do think the uncertainty will likely be a headwind for commercial real estate for the rest of the year.
Do you see a similar situation to what we saw in the pandemic? You were talking about when we were coming out, the warehouse type properties and people were, trying to manage those supply chain issues. Are you seeing something similar to that now with the tariffs, trying to stockpile, I guess, or manage those supply chains? Is it the same type of thing?
So we did see a little bit of evidence of stockpiling, but not enough to really move the space market. I'd say this was mostly space that folks already had and had to do with more of inventory management. I think right now, just given how fluid the tariff situation is what it's done is just sort of put a chill on the market. Again, going back to thinking about if you're a decision maker at a company, do you really feel like you have the information you need to sort of move forward on an expansion or new lease? And the answer for most folks right now is no, but hopefully that starts to clear up here over the next several months.
So with the tariffs, the whole idea, right, is to onshore or bring more production back into the United States. That isn't as easy as it sounds, right? So, companies to find the properties, to find the buildings, that takes time, right? To shift the market.
So several years is sort of the right benchmark for thinking about even trying to put up, a new manufacturing facility. And I'd say that's generous just given the approvals that you need, the workforce you need to hire. So yes, I think what's going on now is setting the stage for shifting things over a period of time. I think the more immediate impact on the industrial market is trying to be monitoring activity at the ports. We have a lot of tenants that effectively are just logistics providers. They're moving goods from A to B to C, trying to make sure that everybody that's ordering things via e-commerce can get what they need in the right time frame. And so we're trying to figure out if the tariffs have meaningful impacts to their business. And again, with how fluid the situation is, it's just something that we don't know yet.
Sure.
Well, and you had hinted a little while ago, Jason, about the migration of people to Sunbelt areas in the wake of the pandemic. Certainly having a larger workforce in a space, particularly when you need people at your commercial location to carry out business, is a draw for employers as well. But have those migration trends and population growth and decline in those different regions, have those trends continued since COVID, or has there been sort of a reversion to the mean?
Yeah, it's been interesting. So as you mentioned, right, markets in Texas, Florida, the Carolinas, and others saw a lot of people moving there, seeking out a higher quality of life. A lot of this is due to better affordability and in some cases, nicer weather from where they were coming from. And the trend has definitely pulled back, but it hasn't gone in a reverse. So it just means that the rate of growth has slowed from those abnormally high levels that we saw triggered by the pandemic. And we're now actually seeing a bit of a rebound in some of those markets that were challenged, like parts of Seattle and Northern California, although these markets continue to struggle with affordability issues that may wind up putting a cap on future growth.
Right. And so this is frustrating for me as a Wisconsinite and a loud, proud Wisconsinite who happens to enjoy the cold weather. But is it really just as simple that it's the nicer weather that draws people to those places? Why have some markets done better than others? And does it make it more difficult to invest in those markets that are struggling given the competition?
So weather is certainly a part of it. I don't know if it's the driving factor. And I think for us, it's as much about, so even if Texas is doing well, it doesn't mean all of Texas is doing well. Even if Wisconsin tends to be a slower growth state, doesn't mean that there aren't pockets here where there's innovation, where there are great things going on and interesting real estate opportunities. So as an investor, I think the key is to be in places with great demand drivers combined with some constraints on adding new supply. You know, if developers put up too many new buildings that compete with yours, you're going to wind up with a mediocre investment. And so that's why it's so important that you target the right quarter, the right neighborhood, the right submarket in any particular city or suburb. You know, real estate will always be local. And the key for us is making sure we're working with partners who are experts in their markets and help build the team's knowledge base. And it's always challenging and it's always competitive. But digging in and understanding what makes a particular place a relative winner is definitely one of the more fun parts of the job.
So, I mean, safe to say that it has been maybe fun, maybe challenging to be a commercial real estate investor here in this decade so far. But SWIB has been really able to weather the storm, and the credit is due to you and your team there. Can you talk about what types of things you and the real estate team have done to make sure that the portfolio stays well positioned during this time of transition?
Sure. You know, the team and I obviously work in a framework, and I always like to remind people that the reason why we've been able to position ourselves for success is SWIB's forward-thinking governance and investment structure. You know, we're never a forced buyer or seller. We're able to react to opportunities with speed and certainty, and that's just a major advantage in a competitive market, and a market that, quite frankly, is only becoming more competitive over time as we've seen more and more institutions look to add real estate exposures to their portfolio. You know, so one of the things that we've been focused on lately is making sure our portfolio is positioned to benefit from some larger thematic trends. So many parts of the world, including the US, are getting older. You have property types like senior housing and medical office buildings, which really cater to that demographic wave. And we've been able to find top-tier partners to work with in these sectors. Yeah, another inescapable megatrend worth mentioning is obviously the continued expansion of technology in our lives. We have AI, smart devices, driverless cars. All these things need data. Data needs data centers. So data centers have been and will be a hot topic in the press, including here in Wisconsin. But through all the noise, we've seen continued strong tenant demand with little signs of slowing down. And some of that is certainly AI related, but it's also from increased use of the cloud and the need to be able to store and access an exponentially growing volume of data. So in this sector and others, it's really about continuing to develop investment themes that leveraging our reputation, the talent on our team to make sure we have access to the best opportunities and the right partners to execute with.
So I think it's important to let the listeners know, as Dusty said, and you emphasized, Jason, that the portfolios have really been able to weather the recent market volatility. And you said SWIB's a long-term investor. So over the last 10 years, the real estate portfolio has returned just over 6.5%. Despite those challenges, you talked about some of the goals. If you had a crystal ball and you could kind of look into that crystal ball, what do you see happening going forward? What is the most challenging thing your team is looking at? And where do you hope the portfolio is in, say, the next 5 to 10 years?
Great question, Chris. You know, our portfolio has held up well on a relative basis, but it's been a challenging period for absolute returns for commercial real estate. As I alluded to, I think all the macro uncertainty makes any sort of V-shaped recovery unlikely. But I'd like to leave you with 3 reasons why real estate feels well positioned moving forward. Number 1 is there are plenty of lenders willing to provide debt. Banks, life insurance companies, public markets in the form of collateralized mortgage-backed securities or CMBS, Fannie Mae, Freddie Mac, and private lenders. Competition between these groups looking to put out capital helps reduce borrowing costs and sets the stage for a healthy transaction market. Number 2 is that supply pipelines have really come in across the board. You know, I did talk about some pockets of oversupply, but once the market absorbs what's being delivered, there's very little behind it. And particularly given what's going on in terms of tariffs and immigration, it seems like the cost to build a new building are only going to go higher from here. Less new supply creates better prospects for rent growth for existing buildings. And lastly, values have already fallen to capture the effect of higher interest rates, so you're at a more attractive starting point than you were 3 years ago, and there's more cushion to absorb bad news. So my hope is that all this means that our portfolio should be in a strong position to grow income and cash flows going forward and help deliver the returns to the WRS.
Jason, thanks for taking some time today. A really interesting discussion on how the real estate team is navigating today's markets. It was a good discussion. Thanks again for joining us on the podcast.
Yeah, thank you guys.
And thank you to all our listeners for checking out this episode of the SWIB Podcast.
The SWIB Podcast is brought to you by the State of Wisconsin Investment Board and produced by PodCamp Media. Branded podcast production for businesses, podcampmedia.com. Editor on this episode is Emily Kasinger and Matt Covarrubias with our sound engineering.
Thanks again for listening. I'm Chris Preisler.
And I'm Dusty Weiss.